Senator Warren.
Thank you, Mr. Chairman. Thank you all for being here today. You know, there's a lot of talk about Section 165 of Dodd-Frank, which requires the Fed to impose some tougher rules on banks with more than $50 billion in assets. The main question seems to be whether a bank with more than $50 billion in assets poses more risk than a smaller bank. It's an interesting theoretical question, but we're not engaged in a theoretical exercise here. We're dealing with the very practical issue of trying to keep the financial system from melting down. Because when it did in 2008, it cost this economy an estimated $14 trillion. That's a lot on the cost side. In theory, the Fed could tailor its rules to fit each one of the 7,000 banks in the country, but we don't live in theory. We live in the world. We know that's impossible, and that Congress is going to have to give the Fed some basic guidance on where they should direct their attention. We have to draw some lines. The question is, how do we draw lines to ensure the safety of the system? So I want to follow up on Senator Toomey's question. In recent weeks, I've asked both Professor Simon Johnson of MIT and Chair Yellen of the Fed whether or not the failure of 2 or 3 banks of $50 billion in assets could pose a systemic risk, and both said yes. So, Professor Barr, you've been doing yes-no questions. Do you agree with Chair Yellen and with Simon Johnson on this?
Yes, I do. I think that if there's multiple institutions of that size that are failing at the same time, it is usually an indication that there's broader weakness in the financial system, and that's why it's important for the Federal Reserve to be regulating for resiliency across the financial system and not just at the very largest firms.
Okay, so you talk about, it sounds to me like we have consensus that 2 or 3 $50 billion banks could pose a systemic risk. Let's ask the autocorrelation question that Senator Toomey asked. First, I want to ask it the other way around. Did we see correlated risk before Dodd-Frank, Professor Barr?
I think there was undoubtedly correlated risk in the financial system leading up to the financial crisis of 2008. We had widespread use of mortgage assets, for example, throughout the financial system as collateral for repo transactions, securities financing transactions, and other items, and underlining special purpose vehicles used in derivatives transactions, so that there was a significant degree of autocorrelation in the lead up to the crisis. And of course, during the crisis, most asset classes became correlated, and that crushed the system.
That's right. Indeed, if we hadn't had correlation, we wouldn't have had the collapse, would we? Is the Fed aware of the problem of correlation?
I think they're quite aware of it.
They're quite aware of the problem and try to cope with it. This is part of what they look for in their regulations, right?
Correct.
Okay. So thank you. On the other hand, I want to look at the other half of this. The $50 billion banks generally pose less risk than a $1 trillion bank or a $2 trillion bank. It would make no sense for the Fed to require the same rules and impose the same rules on a $50 billion bank as it does on a $2 trillion bank. So, Professor Barr, you helped write Dodd-Frank, so let me ask. Does the Fed currently have all the legal authority it needs to tailor the rules so that a $2 trillion bank is subject to much tougher regulation than a $50 billion bank?
Yes, they have all the authority they need, and in fact, they've exercised that authority to impose massively tougher rules on the largest institutions than on smaller ones.
Okay, and then one more practical question on this. Let's say Congress raises the threshold to $250 billion or $500 billion, as has been suggested, but gives the Fed discretion to impose tougher standards on banks below the threshold. That is, you move the threshold and then say you can impose tougher standards. Professor Barr, do you think it's likely that the Fed would actually use that discretion to apply tougher standards to banks below the threshold?
I worry about whether they would in fact do that. I mean, I think Congress decided in the Dodd-Frank Act in a number of instances that the Federal Reserve had too much discretion in the past. And in this instance and a number of other instances, reined in Fed discretion, and I think that was a wise choice.
All right, well, you worry about it, and I have to remember what hangs in the balance is the entire economy, not just of the United States, but the world. You know, Congress chose a very practical approach in Section 165. Any bank that hits $50 billion in assets, a bank that is one of the 40 or so largest banks in this country, will generally be subject to some tougher rules. But that bank can go to the Fed and make the case for tailoring the rules to fit its specific risks. If the Fed isn't doing a good job of using its existing authority to tailor the rules appropriately, then Congress should demand that the Fed do a better job. I'm willing to hold the Fed's feet to the fire to do what the statute says, but simply raising the $50 billion threshold and cutting a whole bunch of big banks loose is a dangerous overreaction, and if it goes badly, it is the American people who will end up paying. Thank you, Mr. Chairman.